Last week, a handful of news stories impacted the price of Bitcoin and the blockchain technology space. The CBDC's developments, countless smart contract hacks, strict regulations, but it's not all negative. More and more countries are gravitating towards Bitcoin and blockchain technology, the latest being South Africa and Chile. Additionally, new DeFi laws are emerging. Tesla's new earnings have revealed that they're holding the remaining Bitcoins. Google now accepts cryptos as a means of payment. To all this, we must add relevant macroeconomic news. Is stagflation becoming a reality? When will authorities get a grip on the rising inflation? To stay up to date with the latest news, check out our website news.mundocrypto.com. This is Mundo Crypto's weekly analysis. If you enjoyed this type of content, be sure to subscribe to our channel. Let's kick off with the technical analysis. In this weekly time frame, we can observe, as mentioned in our previous analysis, a minor bearish trend structure. Last week's candlestick starting October 10th almost touched the $20,000 mark, but it couldn't hold on and closed on the red, forming a kind of doji dragonfly or bearish spinning top. This candlestick represents indecision and even a touch of bearish connotations, similar to the candlestick seen in the previous weeks, within the range it has been trapped in. With this week's candlestick, which hasn't come to a close yet, we saw how, once again, was gravitating towards the $19,700 area, but didn't reach it, placing its current price at around $19,000. This daily chart reflects what we've mentioned in our previous analysis. To watch the video, check out the description box below. We warned of the potential market shakeout on October 13th that could produce short-term price movements that could lead to confusion following a cascade of short positions liquidations or a long squeeze. At the day's closing, a long lower shadow candlestick formed, so we must pay attention to it in the short term. To see a bullish movement, we would have to see a breakout of the downtrend structure, which hasn't been the case. The candlestick on October 14th produced the complete opposite movement. We found a fake out formed in the $19,700 area. While it seemed to go to plan, it ended up heading towards the downside following the liquidation of long positions. In other words, a short squeeze. Throughout the month of October, we have been trapped in this range, which is a very important area due to the following. Here, we can see the importance of the range that Bitcoin's price has been trapped in. As we explained in our October 18th newscast that's been linked in the description box below, on that day there was a chance of not exceeding $19,800 despite the hike Bitcoin's price experienced at the opening. This is because the price is carrying out a common pattern in recent weeks. Although it can lead to any kind of movement accompanied by volume, the price always ends up closing in the 19,200 area, where the greatest buying and selling point of interest is located. In other words, the VPOC. If we were to see an upward movement, the price would have to break the structure in which the price is oscillating, moving on to test the $20,500 zone and consolidating where the throwback and continuation of the movement was seen. If, on the contrary, and most likely due to the pattern that is forming, the price heads towards the downside and we lose the $19,000 area, we would go on to test the most relevant support area of the price, located between $18,140 and $18,530 approximately. There is a possibility that if the price does not hold that support, it could continue to drop and go looking for a very relevant price support at $16,000. Here we can see the SP 500 index's daily time frame in which the minor trend line is relevant and failed to break the SP 500, a move that was similar to that of Bitcoin. It wasn't able to reach the trend line following the bearish divergence that occurred in the short term. A bullish movement was carried out, however, without strength to maintain it. If the minor trend line were to break up, the price would go on to test the 3,840 point zone, forming a double pattern and breaking the intermediate trend line with a bullish movement. This scenario seems unlikely. There is a chance of a bullish movement, but the reality is that the SP 500 has failed to make that first big move. As for a bearish outlook, it wouldn't be able to attain that trend line, and candlesticks would close below the 3,660 point area. This would cause a bearish continuation movement until reaching a new support between 3,550 and 3,590 points. This would lead to a descending triangle formation, a pattern with a continuation and bearish connotation. Should the price head towards the downside, that pattern projection could be triggered, resulting in a drop down to 3,270 points. In our previous analysis, we discussed the bullish structure that has led to this ascending parallel channel in the dollar index since 2008. We also highlighted the possibility that if the 111.8 point area were lost and candlesticks formed below that figure, we would see a three-wave pattern to go on to test the 109 and 110 point area that converges with the minor bullish trend line. Despite this, it is most likely a flat failing at C, where the wave at C is unable to reach the bottom of wave A. This would lead the price heading towards the top part of the ascending parallel channel of the dollar index, located between 115 and 116 points. In a bullish scenario, we would see how the dollar would head towards February 2002's all-time high. On the contrary, it would test the aforementioned 115 and 116 point zone, carry out a movement correction and return to the minor trend area. That said, let's move on to the fundamental analysis. Inflation, and more inflation are the subject of this section. Are we facing a stagflation? Here's everything you need to know. On October 18th, the year-on-year data on industrial production in the United States was published, displaying a notable increase, 5.33% compared to 3.91% the previous month. This is also seen in the monthly data with 0.4%, well above the expected 0.1%. On the labour side of things, for the week ending October 15th, the anticipated number of unemployment claims was 214,000, a decrease of 12,000 from the week's previous revised level, which is better than expected than the figure 230,000. The subsidies renewal figure is worse than expected, sitting at 1,385,000 compared to 1,375,000. Privately owned housing units authorized by building permits had a seasonally adjusted annual rate of 1.564 thousand in September, which is better than expected. This is 1.4% above the revised rate of 1.54 thousand in August, but 3.2% below the September 2021 rate of 1.615 thousand. In September, single-family permits were at a rate of 872,000, minus 3.1% below the revised value for August of 900,000. Housing permits for buildings with 5 or more apartments were at a rate of 644,000 in September. Regarding the second-hand home sales data published on October 20th, it stood at 4.8 million, therefore 100,000 more than expected. However, existing home sales for the month of August 2022 fell by 0.4% since July and 19.9% in the last year. The weakness in home sales reflects the rise in mortgage rates this year due to the rise in interest rates. In the United Kingdom, the latest CPI year-on-year data represents an increase to 10.1% compared to 9.9% in August, reaching an all-time high. The month of July reached levels seen in the 1980s. On a monthly basis, the CPI increased by 0.5% in September 2022, which is 0.1% higher than expected. What is this rise caused by? To a large extent, this is due to housing and household services, such as electricity, gas and other fuels, food and non-alcoholic beverages, and transportation, mainly motor fuels. Moving on to additional data, input producer prices increased by 20% in the year to September, 1.2% higher than expected and a drop of 20.9% since last August. It is the third consecutive monthly drop, although they are still considerably high figures. Output Producer Price Index increased by 15.9% in the year to September, down from 16.4% in the year to August. Crude oil and oil derivatives contributed to most of this descent. In the Eurozone, the Vice President of the European Central Bank, Luis de Guindos, affirmed that the Eurozone is facing a possibility of a technical recession. Quite a way of downplaying a worrying fact within the European economy. Our response, he says, will depend on how the data evolves over the coming months. I think we're going to face a very difficult combination of low economic growth, including the possibility of a technical recession, and high inflation. What does this sound like to you? It seems like stagnation. The Investor Confidence Index in Germany reveals considerably low confidence among investors, precisely 72.2% instead of the expected 68%. It is clear that many foresee an economic decline. And although the ZEW Economic Sentiment Indicator of Germany and the Eurozone holds a better figure of minus 59.2 versus the expected minus 67.5, if we were to compare it with the current situation, it is a rather worrying sign. When the current rate crossed the indicator on the downside, it marked history's worst moments of economic growth. As seen in this chart, it happened towards the beginning of 1992, 95, 2001, 2008 and 2020. The Producer Price Index in Germany was 45.8% higher in September 2022, marking a new high and overtaking the expected 44.7. In other words, the year-on-year change rate of change remained the same as in August 2022. Therefore, the months of August and September registered the highest interannual rate of this index since the beginning of the survey in 1949. In July, the variation rate surrounding the same month of the previous year was 37.2%. The main reason for the increase in trade producer prices compared to the previous year remains the price evolution in the energy sector. Moving on to the year-on-year inflation rate in the Eurozone published on October 19th, it stands at 9.9%, reaching 10.9% in the European Union. The rate of annual inflation in the Eurozone was 9.9 last September, compared to 9.1 in August. A year earlier, the rate was 3.4%. The annual inflation of the European Union was 10.9% in September, compared to 10.1 in August. A year earlier, the rate was 3.6. In short, the Eurozone is at levels of inflation that seem to see no end, an undeniable economic decline. Investor confidence has hit rock bottom, and all of this puts the European Central Bank in check, leaving them with no choice but to raise rates by 75 basis points at the next meeting in November. Seems like we're talking about stagflation, and the possibility of a recession is closer and closer by the day. If you'd like to continue learning about blockchain technology and the most relevant crypto information, follow us on Twitter at MundoCrypto_EN. Link in the description box. Net realized profit and loss measures the net profit or loss experienced by all currencies and is defined by the difference between the realized profit and the realized loss. In this chart, we can see that realized losses outweigh profits. The following chart represents what we've mentioned previously. The net unrealized profit and loss, NUPL, is the difference between the market capitalization and the realized capitalization divided by the market capitalization. Assuming the last currency movement is the result of a purchase, the NUPL indicates the total amount of profit and loss on all currencies in the form of a ratio. It could be interpreted as a proportion of investors making a profit. Values below zero indicate that investors are making a loss, and a decreasing holding in value means that more investors are starting to make a loss. As we can see in the chart, it is considerably blue, sitting at minus 0.10. In our previous analysis, we've discussed what the realized price by age entailed between short and long-term holders, and what the average acquisition price per currency implied for short-term holders versus long-term holders. The whale outflows chart represents the original acquisition prices of whales that were trading Bitcoin on the date specified by the slider. What we mentioned previously is confirmed with this chart, where we see how these whales disposed of those acquired Bitcoins at the start and finish of the previous bull run. On the other hand, as mentioned previously, the $20,000 zone is very important in the order book's heat map and acts as a resistance. Currently, we can see how at the top of the range there's a very relevant area, and at the bottom those areas sit at $18,000